When it comes to managing your money, financial advisors claim to have your best interests at heart. But have you ever wondered how they really make their money? Many advisors earn hefty commissions, hidden fees, and bonuses for pushing certain financial products, sometimes at your expense. Are they truly helping you build wealth, or just profiting off your trust? In this video, we'll expose the truth about financial advisor fees, the conflicts of interest they don't tell you about, and how you can take control of your finances without getting ripped off. Stay tuned. Today, we will talk about why you shouldn't trust financial advisors, the truth about their fees. So before we get started, make sure to hit that like button, also subscribe to my channel. Are financial advisors really helping you grow your wealth, or are they just lining their own pockets? The truth about financial advisors and their fees might shock you. Many people trust advisors to guide them toward a secure financial future, but few realize that these so-called experts often put their own profits first. Hidden fees, commission-based recommendations, and conflicts of interest are all too common. In this video, we're exposing the reality behind financial advisors, how their fees work, and why trusting them blindly could be one of the biggest financial mistakes you ever make. Stay with us until the end, because what we reveal might completely change the way you handle your money. Today, we will talk about why you shouldn't trust financial advisors, the truth about their fees. Before we get started, make sure to hit that like button and subscribe to the channel so you don't miss any of our future videos. Now, let's dive in. 10. Financial advisors are salespeople, not educators. Most people believe financial advisors exist to educate and guide them toward the best financial decisions. But the truth is, many of them are nothing more than salespeople in disguise. They work for banks, investment firms, or insurance companies that push them to sell specific products, regardless of whether those products are right for you. Instead of prioritizing your financial well-being, they focus on commissions, bonuses, and company profits. Their advice is often designed to benefit their employer or themselves rather than the client. So, when you sit down with a financial advisor, ask yourself, are they truly helping, or are they just selling? 9. Hidden fees that eat away your investments. One of the biggest issues with financial advisors is how they make money, through hidden fees that drain your investments over time. Many advisors charge a percentage-based fee on your assets, meaning the more money you have, the more they take. Others charge transaction fees, annual fees, and administrative fees that add up without you even realizing it. For example, if you invest $100,000 and your advisor charges a 1% fee annually, that's $1,000 every year. Over 20 years, that could amount to tens of thousands of dollars, money that could have stayed in your pocket. And that's just the beginning. Many advisors also earn commissions from recommending high-fee mutual funds, insurance plans, and annuities that aren't necessarily the best option for you. 8. Commission-based advice. A major conflict of interest. Imagine you visit a doctor, and instead of recommending the best treatment, they push the medication that gives them the biggest bonus. That's exactly how many financial advisors operate. They make money by selling financial products that pay them a commission, even if those products are bad for you. This creates a huge conflict of interest. Advisors might push expensive insurance policies, actively manage mutual funds or annuities because they earn a percentage from your purchase. The higher the fees you pay, the more money they make. So, instead of recommending low-cost index funds or fee-free investments, they direct you toward products that maximize their earnings at your expense. 7. The myth of free financial advice. If a financial advisor tells you their services are free, be very suspicious. There's no such thing as truly free financial advice. If they're not charging you directly, they're getting paid another way, usually through commissions, referral fees, or hidden charges within the investment products they recommend. Banks and investment firms often advertise free consultations to lure in clients. But once you sit down with an advisor, you'll quickly realize that free comes with a price. They may suggest actively managed funds, high-fee insurance policies, or even unnecessary account upgrades, all of which generate revenue for them and their employer. 6. The 1% fee trap. Why it's more costly than you think. A 1% fee might not sound like much, but over time, it can devastate your returns. Let's say you invest $500,000 and your advisor charges a 1% annual fee. That's $5,000 per year. Over 30 years, assuming a 7% return, you could lose over $500,000 in fees alone. Money that could have doubled your wealth. Even worse, many advisors don't even outperform the market. Most investors would be better off investing in low-cost index funds with fees as low as 0.03%. Yet, advisors rarely recommend these options because they don't make money off them. 5. Most advisors lack true expertise. We'd assume financial advisors are highly trained professionals, but in reality, many of them have minimal qualifications. Becoming a certified financial planner, CFP, or a registered investment advisor, RIA, requires some training, but many advisors working at banks or insurance companies have nothing more than a sales license. Unlike doctors or lawyers, financial advisors aren't required to act in your best interest unless they are fiduciaries. Many simply follow a company script, promoting products that boost corporate profits rather than providing real financial education. 4. Robo-advisors are cheaper and more efficient. With the rise of AI and automation, robo-advisors are replacing traditional financial advisors. These digital platforms automate investment management, using algorithms to optimize portfolios at a fraction of the cost. Unlike human advisors, robo-advisors don't earn commissions and don't push high-fee products. They use mathematical models to allocate assets efficiently, often charging fees as low as 0.25%, far less than the 1 to 2% fees traditional advisors demand. 3. The DI approach. Educate yourself and take control. One of the best ways to protect your money is by learning to invest on your own. With countless free resources available, you don't need an expensive advisor to grow your wealth. Books like The Simple Path to Wealth by Jell Collins and A Random Walk Down Wall Street by Burton Malkiel provide all the knowledge you need to invest wisely. Free courses, YouTube tutorials, and online financial tools can help you understand index funds, asset allocation, and risk management without paying high advisory fees. 2. Advisors rarely beat the market. Many financial advisors claim they can outperform the market, but studies show that most fail to do so consistently. Research from S&P Dow Jones Indices reveals that over 80% of actively managed funds underperform the market over time. This means that even after paying hefty fees, you're likely to get worse returns than if you had simply invested in a low-cost index fund like the S&P 500 ETF. Instead of trusting an advisor who promises market-beating returns, stick to proven long-term investment strategies that actually work. 1. The only advisors you can trust. Fee-only fiduciaries. Not all financial advisors are bad, but you have to know how to find the right one. The only type of advisor you should trust is a fee-only fiduciary. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.